One of the first that I get is, what is the minimum investment that someone can do to participate in one of these deals? And to put it succinctly, 100,000. And that's the minimum that I've set for someone that I have an existing relationship with that's an accredited investor. I'll come back to that in a moment. If for whatever reason someone has a special exception where they maybe need to start out a little bit lower than that, but they have the capacity to do other investments shortly thereafter, and I know you, like, I would have that conversation, but this should be dollars that you're not reliant on. It's not an emergency fund. It's dollars sitting there that you want to get deployed into a deal, and you're happy having those dollars out for at least a few years. Another question that comes up pretty frequently is, what are the typical returns of a deal? And I wish I could say, I can guarantee X number of percentage points. What I can say is that generally speaking, it's a double-digit return. In fact, I set most of my investors' expectations that will be somewhere between 12 and 18% for the overall return on the deal. And that's gonna take things into account like cash flow from our operations, loan pay down over time, rents increasing over the years, and then tax advantages or tax savings. And so when you add all those together, and we do some things like sell a property for a significant profit or refinance to pull some of our cash proceeds out, it's pretty realistic to achieve those double-digit returns. In fact, I'd say those are pretty conservative. On our last couple of projects, we've actually far exceeded that in some cases. It's not a guarantee, and all investments have risk. I don't care what asset class you're in, so you should question anyone who tells you otherwise. But generally speaking, I feel very confident that we can deliver those returns, and I usually won't move forward on a project unless I see a very clean and clear path to be able to get my friends and family those types of returns. Do I have to be an accredited investor? The short answer to that is yes. And what that means is that an individual is earning over 200 grand a year, or they have a net worth of at least $1 million, not including their primary residence. We can link to investor.gov where they define that a little bit more thoroughly. And the cleanest way for me to partner with people is they're accredited investors that I have an existing relationship with. That being said, technically, there are a few exemptions from that. If someone is a sophisticated investor and I have less than 35 people, there's potential for someone to invest in those deals. And that's pretty typical for my projects. So if I have an existing relationship with someone and I don't have a monster syndication with 40 partners, there's still an opportunity. So what I would do is, if you have a question about that or you're not sure if you're accredited or not, go ahead and reach out, schedule a few minutes to jump on and just explore, because everyone's situation is unique, but I gotta be very careful that I'm only really sharing these opportunities with accredited investors that I have existing relationships with. Another common question that comes up is, I'm a big fan of investing in retail and shopping centers right now. And in the age of a pandemic and e-commerce and Amazon eroding or changing a lot of business models, like, is it still smart to be investing in retail? And I would say it depends, largely on the types of tenants that you have in the location that you have. So one of the things that I really focus on now isn't buying giant indoor shopping malls that were really relevant in the 80s, but instead focusing on daily needs centers. Think strip centers or your neighborhood center, or oftentimes your grocery anchored center. So you're going in there to get your groceries and you might have a nail salon next door, and there might be a dog groomer next door. Some of the things that you can't order and get delivered to your door, your barber shops, your hair salons. So a lot of times service centric. We just did a deal with a preschool or a daycare. I don't think Amazon is in that business just yet. So those are the types of durable tenants that you're looking for, and the folks that I want to see in our shopping centers going forward. And when we have those types of tenants in a good location with good visibility that's easy for cars to come in and out of, it's relatively straightforward to keep a building leased up and have those tenants being successful. We're also doing some things with improving signage, with repaving parking lots, making sure that our building is representing the quality and caliber of the tenants who locate in that shopping center. Another common question that comes up is, what does the time frame look like for this deal? Or for that matter, what is the exit strategy gonna be? And in almost every circumstance, in fact, in every deal I've bought, there is a value add component, a big one. In fact, the bigger the problem that we're solving, generally speaking, the bigger the payday. What that means is that we're gonna be able to, let's take the last 4 shopping centers, for example. We bought them with more than 50% upside potential. What does that mean? If we spent $2 million on it, the building would be worth well over $3 million. If I spent $4 million on it, it should be worth more than $6 million when we're all done. That creates a lot of forgiveness or cushion in a deal where even if it doesn't go perfect, and instead of make a projected $1 million, you only make $500,000, we're still okay, right? We're comfortably getting all of our principal back. There's still proceeds and profit that we can distribute out to the ownership group. And there should be the ability to refinance and pull most, if not all, of our cash out of a deal. For folks interested in real estate, you may be familiar with the BRRRR concept, where someone's doing buy, renovate, rent, refinance. It's kind of that same principle, just with an extra comma and more zeros behind it. So you take a shopping center that's 33% occupied, renovate it, lease it up, and then when we hit 80, 90% occupancy, the building's doubled in value. And so we can go to a bank, go to an appraiser and say, hey, the building's now worth $3 million. Piece of cake, they're gonna do a $2 million loan. Now we can return all that capital that we put in as a down payment for it and move that into the next project. From a timing standpoint, we wanna do that as quickly as we possibly can, because then we're gonna get the best cash on cash returns. I would say, generally speaking, lease up for a retail box when we're looking good, 6 months to 9 months is probably an average. We're doing some things now, and we should link to another video here, but there's a checklist that we go through where there's 25 things that we do anytime we buy a building that really give us a higher probability of success leasing up some of these spaces and potentially compressing 9 months down into 9 weeks. And so we can go through some of those specifics in more detail. That stabilization or lease up period might take 6 months, it might take 9 months, it might take 12 months. I'll give you a specific example. Our last project in Goodyear, Arizona, we took from 50% vacant to 100% occupied, bought, sold, closed, and exited the deal in 14 months. Doesn't mean the next deal is gonna happen in 14 months, but it could be that fast to get all of your capital returned and your share of the profit potential. The deal before that was about 18 months, so it could be a little bit longer, could be a little bit faster. Generally, what I'm gonna do is set people's expectations that we're gonna be in a deal for 3 to 5 years. And at that point, there'll either be that refinance or that sale, but plan on not touching that principal for that 3 to 5 year time frame. Hopefully I can do it much faster than that and impress all of my investor partners. In the rare circumstance that someone gets kind of desperate and they need to have their principal or their capital back, there's a scenario where we can work with someone on that. Generally, I'm liquid enough that I could cash out any given partner or two on a property myself. There's also a wait list of folks looking to get into our next deal or two. So we could turn to that investor and say, hey, do you want to buy out Aaron's position in this deal? That person could then step in, buy out their shares effectively, and someone could exit. Probably not for the same payday that they would have for staying in the project for the whole time period, but at least it gives you some options where some of the bigger institutional players that I know might have an absolute 7-year lockout period where you just can't touch your money regardless. So I try and work with people as best I can if they have a unique circumstance.